Good afternoon. This is Tom Alexander. It is Saturday, February 3rd, and this is the weekend update for next week. And a couple of things. You can get this report, the full report, by going to my website, alexandertrading.com. Click on Weekend Update, and you will see the reports for each week, including this one. And it's free. You don't have to sign up for anything. You can just click on it and see it. So all the charts that I'm going to show you, all the comments that I'm going to make, you can get in hard copy from the website. I have you can download a PDF there. So just FYI. Also, if you find value in this, I would very much appreciate it if you would like the video, if you would subscribe to the channel, if you make comments or have questions, I'm happy to respond. Okay, I think it's safe to say that we are in an extraordinary rally in 3 of the 4 indices. Actually, and I'm going to show this in just a minute, the Russell has as well. I think it is sort of, there's a lot of attention regarding the divergence at the moment between the all-time highs and the Dow, the NDX, the SPX, and then the fact that the Russell is lagging. And we're going to discuss that. Let's go to the charts. There's a lot to discuss this week, by the way. So hang with me, please. There's a lot of, I think this next week coming up is the most critical week we've had this year. Now I realize the week is the year is young, but this is going to be a very, very important week, and some interesting things are setting up. So please bear with me and stay to the end of this video. Okay, let's take a look. Okay, I'm going to start just going through each index, each of the 4 primary U.S. trading indices. Start with the SPX, and you can see we closed Friday very close to the high of the day. We would have closed on the high of the day if we hadn't started dropping bombs. The U.S. hadn't started dropping bombs at 4 p.m., but it did. And there is nothing above Friday's high in terms of resistance. Now, the round number of 5,000 could be a magnet. And why? Well, it's related primarily to options. And options tend to be clustered around round numbers and quarters. So like 49.50, 49.75, but 5,000 is going to be the big round number where you're going to have clusters of option strategies and strikes and a lot of volume around that area. So that could be a magnet. Now, to the downside, we've been so vertical. The downside area of interest begins at about 48.55 down to about 4,800. 4,800 is an important level because we had trouble breaking through it. We finally broke through it rather dramatically. Really never tested it, or haven't so far, but that's an important area. Now, clearly, I want to point this out. The simple things in trading and in analysis are so overrated. And the reason, or underrated, I should say, not overrated, underrated. And the reason is because you can't sell them. It's too obvious. You can't make a magic indicator out of it. But this market is making higher lows, higher highs, of all degrees into this point. So the initial signal a trend has changed and something is developing to the downside is when a lower high is taken out in a given time frame. Now, on the daily chart, that would be way down here at about 48, 42. Now, clearly, you can go to an hourly chart, a 240-minute chart, a 30-minute chart, a 5-minute chart, and do the same thing. But if, people spend far too much time trying to figure out some magical analysis when it is truly the simple things that work. I mean, this market is, here's a trend line. I mean, this is simple stuff, and it's objective, and it does work. So let me move along here. All right, the NDX, of course, is actually the SPX is the one outperforming at the moment, but the NDX closed at another all-time high. Let's go to the Dow. The Dow closed at an all-time high, and we get to the Russell. Now, something I want to point out about the Russell, yes, there is a significant divergence at the moment, but between the Russell and the other primary U.S. trading indices because it's lagging. I do want to point out, however, that the Russell led the charge higher into the December top. It was up almost 27%, and that exceeded any of the other indices. And since then, it has sort of been languishing. And, the Russell is a different index. Clearly, I don't have to tell you guys this. We have about 6 or 7 stocks that are driving the other 3 indices to varying degrees that are not in the Russell 2000, because the Russell 2000 are smaller cap stocks. But the Russell did have this furious rally. This is an important level, this 2011 level, because it held so many times over the past year or two, and we broke above it. That was potentially very, very bullish. And now we're below it, and we're stuck in the middle of a range between the low here around 1896 and the high here of 2011. However, even at Friday's close, the Russell is still up quite an extraordinary amount in a short period of time off the October low. Now, that's not to make light of the concern that the Russell is lagging and something needs to change. More on what needs to change. There's something else that needs to change, and I'll get into that a little bit later. I have a lot to cover today. I'm trying to be coherent, so just bear with me. So those are your 4 indices. Now, I want to take a look. I want to show you guys something that is quite extraordinary. And this is the SPX. Now, what I have done here, this is the rally into Friday's high. This is from the October low. This is into Friday's high. And that rally has carried about 21.24% from print low to print high. The biggest retracement in that rally so far, has been about 2%. That's what's extraordinary. We've traded 66 trade days into, and we've rallied 21.24%. The largest retracement has been 2%. Now, we had a similar rally that began in March of 2023, carried into July. That was 94 trade days, and it was similar. Now, you did have a little bit more retracement involved along the way in this rally. This was about 3%. This was about 2.5%. Now, this was extraordinarily vertical, but this has outdone it. So what I wanted to do, and what I did, I went back to try and find rallies of similar magnitude to see how many there were and what happened. Now, the fact that we've rallied this far, one thing that I'll tell you, does not necessarily mean we're forming or we're on the cusp of a major high. We could be, but that's out. I don't do that. I don't predict crashes and 75% declines. I'm a trader, so I'm interested in the next 3 to 5% move, and then I'll take what else comes. That's sort of how I look at the market. So where are we? Well, certainly the trend is up. It can't be denied. Higher highs, higher lows. You can see this trend line. But let's go back, and I'm going to go back in time. And I want to show you now, you can make the case that we're in a bull market off the October 13th, 2022 low, that this has been a bull market. And why would I make that case? How could you not make that case? We've been persistently higher, and every time we have retraced, we've made a higher high against the previous pivot low. And that's been going on, the pivot low of the same degree, okay? So I would make the case that we've been in a bull market since October 2022. I'm not going to get in a semantic fight with people that want to argue what is a bull market, what is a bear market, and all this other stuff. I'm simple. Higher highs, higher lows, bull trend. We're certainly in a bull trend, okay? Now, and the reason I point that out is because I want to compare apples to apples, oranges to oranges. Well, you could say we were in a bear trend off of this high that formed in early January 2022, and we traded down. Well, I wanted to show in that bear trend, this was a 19% rally, which was at the time seemed rather dramatic, didn't it? Okay, all right. So this was clearly a bull trend. This was the top of the bull trend that began at the 2020 low. So let's go back and look at the legs up off of that 2020 low, just to get an idea, just to get a perspective of the magnitude of the current rally that we're involved in. So this was a rally of 11%. You can see we had a very deep retracement. This was a rally of about 12%, very deep retracement. Now, this was November of 2020, and we had a correction, and we rallied 22% and had a 5% decline. Now, look at this. I didn't highlight every little wiggle to the downside here, but there were numerous declines of 2+% along the way. And see, this hasn't happened yet. So maybe we're going to be up 30% or 35% before we get a 5% retracement. But I just don't think you're going to see that until we start to get a more rotational market with deeper retracement, something in the neighborhood of a pretty consistent 2, 3, 4% retracement. All right, this was a rally. This was a 20% rally. Then we had a 10% decline. This to me is most interesting. All right, so this is the 66 days that we're currently in and counting in the current rally. And the rally off of the March low, this was about as extreme a downside condition from any technical measures as I have seen in the 38 years I've been trading. The market was extraordinarily compressed here, and it bungee jumped ferociously, and it was up about 20.33% in like 5 or 6 days. But from that level, you had a 7% decline. Then you had a 20% rally. Then you had a 6% decline, and so on. Now, before this, into this high in 2020, similar situation. This was almost a 19% rally. But along the way, it was very two-sided. You did have pockets of balance. You had pockets of retracement. This was off the 2018 low. This was an extreme, quote unquote, oversold condition by most measures also. And you had a 25% rally. But again, along the way, you had retracements and pockets of balance that occurred. And that's what's so unusual about the current rally we're in. We really have not had, we've had very, very few and very, very shallow retracements, and certainly time-wise. So that the point of this exercise is to show that. Now I'm gonna go to the 2000 low here. I know that seems like a long time ago, and it was, but I'm trying to give you a sense of scale here, a sense of perspective. All right, this is way back in 2000, and obviously we had a manic, what was considered at the time to be a manic rally in 1998 and 1999, right? Everybody's always talking about the furious levels that we reached in terms of valuations in 1998, 1999 that led to the giant top in 2000. And that's all true. So here's a 24% rally, here's a 29% rally. So we're getting into the neighborhood of the largest magnitude rallies that we've seen in recent trading history. And, you know, it's just a real heads up. Okay. Now, I want to segue over to market structure. What is market structure from a profile perspective suggesting? Well, here we are. This is the weekly chart. Each letter, let me do this. I'm going to remove all the splits. Okay. So what we have here, this is the profile view, the weekly profile view. Is actually each profile unit you see here is a quarter, each letter is a week. So I'm going to split this out and essentially make it a bar chart, except instead of bars, it's letters. But the important thing here is this is another view of how vertical this market has been and how unusual it is. We've only had one little pocket, one minor pocket of balance in here. And it was very, very shallow, like 2%. And we just go up, 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 up. We're way overdue for a more rotational market that includes deeper retracement. And that's what this is showing. Now, the final chart I want to leave you with is this. This is the chart that is a real concern from a couple of different perspectives. First of all, this rally is extended by any measure off of the October low. It's also extended from the low that we saw last Wednesday into Friday's high. Now, the red line you see here is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. And this is breadth. It's NYSE closing breadth. We are diverging rather significantly, rather dramatically, I might add, and the against the higher highs in price. The 10-day moving average of advancing issues is rolling over below the momentum peak seen here. The 5-day is actually rolling over in several different degrees. It's rolling over against this month, the 25th, and it's rolling over certainly against here and here. So there's several degrees of divergence working at the moment in the 5-day moving average of advancing issues against price. Now, this is what's most bizarre. I don't recall in my trading days, and I've been trading a long, long time, and I've been using this price breadth stuff almost as long as I've been trading. On Friday, we closed negative 988 NYSE issue. So almost 1,000 more stocks closed down in the universe of the NYSE body of stocks than closed up. And we had a wide range up day. I will tell you that I would bet the farm that on Monday, this corrects itself one way or the other. We're going to see a rather dramatic move back to the upside, or we may have put in a short-term top and we're going to get a more rotational market that includes some retracement, and it's likely to be sharp if that's the way this immediate divergence resolves. So next week is going to be another interesting week, guys. Again, I hope you have found value in this. If you did, please like, subscribe, make comments. You guys enjoy the rest of your weekend.